Defining the bull, understanding the nature of a bull market. A bull market represents a period of sustained price increases in the stock market. It is characterized by investor optimism, strong economic growth, and rising corporate profits. During a bull market, investors are eager to buy stocks, driving prices higher. This upward trend creates a self-reinforcing cycle as rising prices attract more buyers. Bull markets can last for several years, creating the illusion of a continuously rising market. However, it is important to remember that bull markets are not permanent. They are cyclical in nature and eventually give way to bear markets, which are characterized by declining prices. Understanding the cyclical nature of markets is crucial for making informed investment decisions. The allure of the bull, unraveling the misconceptions of easy profits. The allure of a bull market lies in the perception of easy profits. When stock prices consistently rise, it can seem like an easy way to make money. Media headlines often fuel this perception, highlighting success stories of investors who have made fortunes. This can create a fear of missing out, or FOMO, leading investors to make impulsive decisions. However, this perception of easy profits is often misleading. Investing in a bull market carries inherent risks, as with any investment. The allure of quick gains can cloud judgment and lead to poor investment decisions. It is essential to approach bull markets with caution and a long-term perspective. The perils of overvaluation, navigating the risks of inflated stock prices. One of the significant risks of investing in a bull market is the potential for overvaluation. As prices rise, stocks can become detached from their underlying value. This means that investors may be paying a premium for stocks that are not fundamentally justified. Overvaluation can be driven by market sentiment, speculation, or even irrational exuberance. When stocks become overvalued, they become vulnerable to sharp corrections. A correction is a sudden drop of 10% or more in the stock market. Corrections can happen quickly and unexpectedly, catching investors off guard. Overvalued stocks are particularly susceptible to corrections, as their inflated prices are not supported by strong fundamentals. Market corrections, the inevitable reality check for bull markets. Market corrections are a natural part of the economic cycle. They serve as a reality check for overheated markets, bringing valuations back in line with fundamentals. While corrections can be unsettling, they are a healthy part of a functioning market. It is important to remember that corrections are distinct from bear markets, which are characterized by prolonged periods of declining prices. Corrections can be triggered by various factors, including rising interest rates, geopolitical events, or simply a shift in investor sentiment. During a correction, it is essential to avoid panic selling. Instead, investors should focus on their long-term investment goals and avoid making rash decisions. History is replete with examples of investors who suffered significant losses by investing heavily in overvalued stocks during bull markets. The dot-com bubble of the late 1990s is a prime example. Investors poured money into internet companies with little to no earnings, driven by speculative fervor. When the bubble burst, many investors lost their entire savings. Another example is the housing bubble of the mid-2000s. Easy credit and lax lending standards led to a surge in housing prices. Investors, believing that prices would continue to rise indefinitely, took on excessive leverage. When the bubble burst, it triggered a global financial crisis. Diversification is a risk management strategy that involves spreading your investments across different asset classes such as stocks, bonds, and real estate. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. Diversification is particularly important during bull markets, as it can help mitigate the risks associated with overvalued stocks. When one asset class is performing poorly, others may be performing well, helping to cushion your portfolio from losses. While bull markets can be tempting, it is essential to approach them with caution. Avoid getting caught up in the hype and making impulsive decisions. Instead, focus on a long-term investment strategy that aligns with your financial goals. One approach is dollar-cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps to reduce the impact of market volatility and can be an effective way to build wealth over the long term. Investing is a lifelong journey of learning. The financial landscape is constantly evolving, and staying informed is crucial for making sound investment decisions. Remember that past market performance is not indicative of future results. Subscribe to our newsletter to receive regular insights, analysis, and practical advice on navigating the complexities of the financial markets. Let's embark on this journey together.